Hi everyone, what is up? Welcome back to the channel. This is Aram Dela right here again. And if you are new to this channel, all I want you to do is to hit that subscribe button, like, and leave a comment. So as you guys can see from the title of this video, this is the complete beginner's guide to Forex trading. So if you're started, you've heard about what Forex trading is, and you don't know where to go, this video is for you. Today's video, I'm going to be breaking down everything you need to know when starting the Forex market. So without further ado, let's just dive right into it. So the very first thing we are going to be talking about is what is Forex. Forex is also an acronym for foreign exchange. Forex simply means the buying and selling of currencies on an online platform. It is open 24 hours a day, 7 days a week. It is also a decentralized market where all the global currencies are being traded. So you can think about commodities, stocks, everything is included in the Forex market. The Forex market is also the most liquid market in the entire world, with over $7 trillion traded every single day. So traders can consist of big banks and institutions, retail traders like you and I, and other big companies as well. So when it comes to Forex trading, it works like any other transaction, just like using one asset to buy another asset. So for example, you go into the Forex bureau, you have $100 and you want to change into Naira or CFDs or any other currency. You are definitely going to be selling that $100 you have in exchange to gain what you desire. In this case, a Ghana cedi or a Naira. So in the case of Forex trading, the market price tells a trader the exact amount that is required to buy one currency against the other. So for example, if you needed 12 Ghana cedis, how much of dollars would you need in order to purchase that 12 Ghana cedis? Now, let's talk about some advantages of Forex trading. In every business, we have advantages and disadvantages. However, over here, we're going to be talking about the advantages. The number one of them is it has high liquidity, meaning that the market could be very active. As I said earlier, we have over $7 trillion that is traded every single day. So there's a lot of money to be made on the market every single day. The market will always present an opportunity for you and I to be able to make money on the market. Number two, low barrier to entry. Anyone at all, and I mean it, anyone at all can get into Forex trading. Whether you're a complete beginner, whether you have little to no capital, anyone at all. Thank God for brokers. They give us the opportunity to open a Forex account with as low as $10. Back in the day, you needed high capital to be able to trade the Forex market. But thank God for technology today, you're able to open a brokerage account with as low as $10. Another advantage is trade anytime you want and anywhere you want. As far as you have a computer connected to the internet and a phone, you are able to trade the Forex market. However, the Forex market is also open 24 hours a day, 5 to 7 days a week. And I say 5 to 7 days a week because some pairs actually do trade on weekends, like BTC, USD, and Ethereum USD. Another beautiful and amazing advantage of trading the Forex market, which a lot of people trade the financial market for, is ultimate freedom and financial freedom. Think of the fact that you are able to do anything at any time because you have a skill set that can allow you to work from anywhere and at any point in the world. That is one of the biggest things that people strive for when coming into the Forex market. They want to be able to work on their computer on a vacation or an island in Santorini and be able to make money off their laptop. This is true financial freedom. Now, let's delve into currency pairs. What are currency pairs? A currency pair is a combination of two national currencies valued against one another. Its purpose is basically to compare the value of one currency against another. So for example, if you have the British pound against the United States dollar, it means that the British pound is being compared to the United States dollar in value. The exchange of two currencies is quoted in a pair. As I said earlier, the British pound against the United States dollar. You can also have some examples like the euro against the United States dollar, the British pound against the Japanese yen, and so on and so forth. The reason for this is very simple. Anytime you are exchanging on the Forex market, you cannot be exchanging one currency. It has to be two currencies, one against the other, therefore brought together, being called a currency pair. Anytime you see a currency pair, the very first pair is what we call the base currency, and the second one is what we call the quote currency. Currency pairs can also be divided into two major parts. We have the major currency pairs and then the minor currency pairs. To make things really simple, a major currency pair is a currency pair that has USD attached to it. So think about it, any other pair in the world, as far as it has USD attached to it, is a major pair. So let's have a small quiz over here. Can you mention 5 currency pairs that exist in the market. I'm giving you guys 5 seconds to be able to do this. Congratulations if you're able to do that. Some examples are GBP USD, Euro USD, USD JPY, USD CHF. As far as they have the USD attached to it, then it is a major pair. Now let's talk about minor pairs, or you can also call them crosses. Basically, crosses are currency pairs that do not have the USD attached to it, obviously. So now let's talk about some. Maybe you can have the GBP CHF, CHF JPY, GBP NZD, NZD JPY, and so forth and so on. As far as there is no USD attached to it, then we can call this a minor or a cross pair. Now, let's talk about some common terminologies while trading the Forex market. Now, when we are talking about some of the major terminologies that we can have in the Forex market, a lot of you guys get really confused. But here we are going to be listening to some Forex lingos and you can get yourselves acquainted to it. One of the popular ones is long, the word long. Now, anytime you hear a trader say, I'm going long on this pair, it simply means that he's buying, meaning that he's allowing price, he's buying price from a low point and expecting price to appreciate over a period of time. This simply means that he is buying the base currency and selling the quote currency. So for the case of GBP USD, if I say buy GBP USD, it simply means that I am buying the base currency, which is GBP, and selling the quote currency, which is USD. So I'm buying more of GBP and selling more of USD. As simple as that. Now let's talk about the next one. Short. Basically, a short in the Forex market simply means that we are selling one currency against the other. That means we are selling price from a very high point and expecting price to drop all the way to a low point. Technically speaking, we are selling the quote currency and then we are buying the base currency as well. Now let's talk about pips. You hear a lot of people talking about pips. Pips simply means percentage in profits. A pip refers to the smallest possible movement on the Forex market charts. So if you have ever thought of the fact that we'd see the prices of the dollar or the prices of the Ghana cedi or the naira fluctuate over a period of time. Maybe you wake up one morning and the dollar price against the Ghana cedis is 12 cedis 20 pesos. The next day you wake up, it is 12 cedis 30 pesos. Price has moved about 10 pips in difference. That means you calculate the difference between the current price and then the price appreciated or depreciated over time. That small movement is what we call the pip in percentage. Most pairs go out for 4 decimal places, but in the case of the JPY pairs, they do 2 decimal places when you are counting pips. Now, let's talk about the broker. The broker is basically a financial company that gives you access to the financial market. You alone as an individual cannot access the financial market alone. You would need an intermediary, which is called a broker. That gives you leverage and access to be able to trade the financial market. The broker that I always and usually would recommend is Exness. Make sure to check the link in my description box to sign up for Exness. And make sure that when you are signing up for Exness, inside the partner code, you write ARAM. Now, let's talk about the bid and ask price. The bid price refers to the price at which you can sell, and the ask price refers to the price at which you can buy. It's really simple. Anytime you are trading the Forex market, if you look closely on the chart, you realize that it's not always one price. There's always a bid price and an ask price. Now, let's talk about spread. One of the best things that can ever happen to you is trading with very low spreads on a platform or on a broker. Now, spread is basically the difference between the bid price and the ask price, as simple as possible. Now, let's move on to the 7th point, risk to reward ratio. These are some Forex lingos that can help you as a complete beginner to understand anytime you enter a room full of Forex traders. What is risk to reward ratio? Risk to reward ratio basically has to do with how much risk you are willing to take as to how much you are willing to gain. So if you are willing to take a risk of 10 and willing to make a profit of 50, it means that you have a risk to reward ratio of 1:5. Therefore, you are risking 10 in order to make times 5 of whatever you are risking. I hope you guys get it. Now, let's talk about slippage. Slippage refers to a situation in the market where price moves so fast other than the intended point you enter the market. So for example, this also happens during high volatility events like NFP and then certain geopolitical events. So maybe you are entering price at maybe 1.2500 on GBP USD and price moved so fast that you entered at that exact point, but price triggered in another price position This is simply because of slippage. The price moves so fast that the computer or the technology was not able to record it at that given price. Now, let's talk about a sell limit order. What is a sell limit order? It's a very simple explanation. Let's put it into physical terms. Now, let's say you have a $100 bill currently valued at 12 Ghana cedis per dollar, and you're expecting price to get to 16 cedis per dollar before you sell. That is a pending order. You are not going to be doing anything until price gets to that point. So as soon as price gets to that point, you are then going to sell off your dollars. Now, this can be done automatically because of technology on your Forex broker. You can decide that when price gets to a particular point, you expect it to trigger and your trade gets active. That is a sell limit order. Now, let's talk about a sell stop order. A sell stop order is basically a pending order to sell a currency pair at a lower price other than the current price it is at the moment. Now, let's also talk about a buy limit order. And I'm guessing you already understand it based on the explanation of what a sell limit order is. A buy limit order is a pending order to buy the currency at a lower price point, whatever the price that you want to trade at, other than the current one. Now, let's talk about a buy stop order. What is a buy stop order? So a buy stop order is basically a pending order to buy a currency at a high price point other than the price you wanted to buy at. Now, let's talk about a stop loss order. I know this has to be one of the most popular things you hear. I've hit my SL, I've hit my SL, the market took me out, I hit my stop loss. What is a stop loss? A stop loss is basically a protection tool that allows you not to get liquidated on your account. A stop loss order is an order to exit your trade at a particular given point so you don't risk more than you have intended to do. It is basically a risk management tool meant to save you and your trading capital. What is a take profit order? A take profit order, like the stop loss order, is also an order that is set for you to take profit at exactly where you are looking to. So for example, if you're in a trade and maybe you are targeting to make maybe $50 on a trade, and you don't have enough time to be able to watch the chart until it gets to that $50, you can set an automatic take profit order and say that when price gets to $50, I want you to close my trade. As simple as possible. That is what a take profit order is. Now let's talk about lot size. A lot size basically is the number of currency units that you will be buying or selling in the Forex market. There are different types of lot size. We have the macro lot size, we have the mini lot size, and we have the nano lot size. The most common Forex lot size you'd ever see on the market will have to be the standard lot size and the mini lot size. There's a very simple formula I have here on how to calculate your lot size. It's a very simple one. It has to do with your lot size times 10 times the number of pips. And oh yes, I've taught you guys already understanding pips and what exactly is pips. So for example, if you sold GBP USD and you made a profit of $50 using a standard lot of 1, your gains will be calculated as 1 times 10 times 50. And that gives us $500. Thus, you made a profit of $500. Now, let's talk about margin. What exactly is margin? I know some of you, when you open up your Forex broker, you are going to be seeing your margin, your balance, your equity, and a whole lot. What exactly is margin? A margin is simply a portion of your funds that your Forex broker sets aside from your account balance to keep your trade open and to ensure that you can cover the potential loss of a trade. So if you look at your account, you're going to see your balance, your equity, and your margin. If you want to buy $100,000 worth of USD JPY, you don't need to put the full amount. You only need to put a portion, like $3,000. The actual amount depends on the Forex broker. Now, let's talk about leverage. A leverage basically refers to how much more you can trade relative to the account size you have. For example, let's say you have a $100 account and you're using a leverage of 1:50. This means that you can control 50 times more than your initial capital. It's very simple. Let's have a quick example. Let's say you are using a leverage of 1:100. That means you can control 100 times more than you intended to control, or you have to control. This means that your broker lets you trade up to $5,000 worth of currency with your $100 account. A leverage is basically a feature offered by a broker to allow traders to trade a large amount of securities with a small size. It is expressed in ratios as to 1:50, 1:100, 1:500, and so on and so forth. Now, let's talk about fundamental analysis. So fundamental analysis is analyzing the currency's price forming, basically with economic and other factors influencing the exchange rate in the country, depending on where you are trading from. It is the analysis of the economic and political informations with the hope of predicting future currency price movement. The key factors influences fundamental analysis: interest rates, inflations, which is CPI, we have the GDP, employment, and even unemployment rates as well. These factors can hugely and greatly affect the financial market. What is the role of the central bank? Central banks are independent institutions utilized by nations around the world to assist in managing their commercial banking industry, to set central bank interest rates, and also to promote financial stability throughout the country. Central banks also make policies based on prevailing data, and they have extraordinary power to be able to push the market. Don't forget that. To understand some economic data, we are going to be talking about interest rates as well. Now, with interest rates, it affects the forex market in the way that it shapes how a currency value is perceived. So changes in the country's interest rate will impact the exchange rate between the domestic currencies and the other global currencies as well. Interest rates are of utmost importance to forex traders. This is because when the expected rate of interest rates change, the currency generally follows with it. The central bank has several monetary policy tools it can use to influence the interest rate. There are other economic indicators such as Consumer Price Index, which is also popularly known as CPI, others as GDP, which is Gross Domestic Product, and then unemployment and employment rate. Now, let's talk about technical analysis, my favorite part. Technical analysis helps us to be able to predict future price movement. That is the price moving from one point to another. There are different kinds of indicators and charts that allow us to be able to trade on the market. Now, let's talk about some types of trading. The very first is position trading. If you want to be positioning trading, it simply means that you want to be catching the market and be able to trade the market on a very higher time frame. For example, the daily and the weekly. Position traders normally hold trades for more than a year, and that is not the kind of trading we want to do as retail traders. Now, to swing traders. A swing trader is basically a trader that captures trends markets using the 4-hour to the daily time frame. Traders can stay in the market for up to weeks or even days. Now, to day trading, which I do. Day trading is a faster form of trading that allows you to be getting in and out of the market and making gains for yourself on a day-to-day basis. Day trading can actually range from the 15 minutes time frame all the way to the 4-hour time frame, using technical analysis to be able to make money off the market in and out at any point in time. Scalp trading refers to a short-term type of trading where traders get in hugely with high volumes with very high risk and get out quickly just when they've made enough profit for themselves. So now guys, let's talk about market structure. What is market structure? Market structure defines the market condition and aids traders to know what trading decisions to take. In the forex market, trends reflect the average rate of changes in price over time. Trends exist in all the time frames. A trend is one of the most important aspects of the market, which traders really need to understand. So in today's video, I'm going to be showing you guys 3 types of trends in the market. The very first one is an uptrend. The second is a downtrend. And the third is a sideways market, which can also be called a ranging market. Now let's look at what an uptrend looks like. So in an uptrend, the market shows a series of higher highs and higher lows, a higher high and higher low, a higher high and higher low, and a higher high. So once we begin to see successions of this in the forex market, then we know that this market is in an uptrend. Now let's look at some examples on the chart. So I'll be taking just a small portion over here so you guys can be able to see what exactly an uptrend looks like. So if you look in this portion right over here, you would see that this market is in a clear uptrend. In this case, we are seeing the market showing a series of higher highs, higher lows. We saw the market going all the way to form a high, a low, market from equal highs, a low, a high, a low, a high, a low, equal highs, equal low. So this is an uptrend. This indicates that the market is moving in an uptrend. The more you practice this, the more it's going to help you. If you are interested in having free access to my beginners course, make sure you check the link in the description and join the Telegram group to have access. Now, let's talk about a downtrend. In a downtrend, A forex market is characterized by a price declining in the currency pair, creating a series of lower highs and lower lows. So in this particular situation, we can clearly see that this market is in a clear downtrend. We can see the market has formed a lower high, dropped all the way into this area to form a lower low, then pushed up a bit to form a lower high, dropped all the way to form a lower low, a lower high, dropped again, a lower high, dropped again. So the market keeps creating a series of lower lows, lower lows, lower lows. Once the market begins to create a series of lower lows, lower lows, lower lows over a particular point in time, then we know that this market is in a downtrend. Now, let's talk about sideways market. A sideways market basically is a market that is moving sideways. Basically, this market has no clear direction. So in this case, we can see right over here that this particular type of market is in a sideways market. The market keeps moving in a sideways direction. Therefore, there is no particular direction. And most of the times, we don't want to be trading this type of market. However, you can actually be catching the market based off the low points and the high points. Now, that brings us to the next point, which is support and resistance. What is support and resistance? A support is an area where buying pressure could step in, right? Therefore, it denotes a price level where buyers could come and push the price higher. Similarly, a resistance is also an area where selling pressure could step in. Also denotes the price levels where sellers could come in and push the price lower. When a support is broken, it could become a resistance. Same way, when a resistance is broken, it could also become a support. Always remember to adjust your support and resistance levels because price may not always respect the levels as new ones keep forming all the time. Now let's talk about them. Let's start with the resistance. A resistance is an area above price points where price respects. So let's say I'm watching this current market right now and I'm looking at how the market has just created this particular area over here. This is a resistance because we want to be asking ourselves and wondering, why did this market get to this point and reverse? So meaning that there is some sort of resistance here. So if price should ever get to this point, there is a high probability that this market could reverse because we already stated that a resistance is an area where selling pressure could step in. So that means when price gets here, there could be selling pressure where price will move from this particular area and sell all the way to the downside. So watching this market, we can possibly see that as price is beginning to push to the upside, when price gets into this area, what happens? There was a selling pressure all the way to the downside. Therefore, we can say this particular area in the market is what we call a resistance. Does everyone get this clear? Now let's talk about what a support would look like. So for a support, we are going to be looking at some examples over here, and I found one very simple one. So as I said, in a support, we are watching how price just got to this particular area and all of a sudden price just pushes up. So for a support, it is where buying pressure could also step in. So as we are watching this area, there's a possible chance that if price should get into this area, price would push up strongly, at least into this area. And also, we can also see a resistance over here as well. So now let's watch how price reacts from these particular areas. So we are going to be seeing how price will react from this area, and we are going to be seeing how price will react from this area. So let's see it. So just when price gets into the support region, let's see how the reaction starts. So you see the buying pressure stepped in, and this is enough for us to be making money on the Forex market. Now let's watch as price goes up. So this is very interesting to know. Over time, you would realize that price finally broke this particular support. And as we said earlier, anytime price breaks a support, it also becomes a resistance, simply because a resistance is an area above the price point. So at this particular point in time, this particular area is no longer what we call a support, but a resistance. As far as price does not trade above it, it will continue to be a resistance. So watch this, guys. As price came into this area, selling pressure could step in, and guess what? Price also reacted from this area and sold. So if you begin to master support and resistance, you're going to go a long way to become a successful trader. Let's talk about candlestick patterns. Basically, everything that makes up the chart and everything that you see over here is what we call candlesticks. However, there are certain candlestick patterns in the market that can identify for bullish goals or bearish goals. A candlestick makes up any given chart and are a visual representation of price fluctuations in the market. A candlestick displays the open, the high, the low, and the closing price of a currency pair or an instrument. Very similar to a modern day bar chart, but in a manner that mitigates the relationships between the opening and the closing price. Each candlestick represents one time frame. So for example, if I come to the 15 minutes time frame or the 30 minutes time frame, or if I come to the 1 hour time frame, each candlestick on the 1 hour time frame simplifies that it took 1 hour for this candle to form. If I come to the daily time frame, each candlestick signifies that it took 1 full day for this candle to form, or 24 hours. If I come to the 3 minutes time frame, it simply means that for each candle you see, it took 3 minutes for a full candle to be able to form. Now, let's talk about bullish reversal patterns. What is bullish, or what is long reversal patterns? Remember, bullish patterns may form after a market downtrend, meaning that if price has sold all the way to the downside for a very long time, there could be an indication that the market will eventually one day rise to the upside. However, we want to be knowing how the market is going to give us that indication that it is time for us to buy. That is where bullish reversal patterns come in. There are about a few bullish reversal patterns that are popular and they are mostly seen on the market. Now, the very first of them is the hammer. Now, a hammer is a candlestick pattern and is formed of a short body with a long lower wick and is found at the bottom of a downtrend. So in the case of a downtrend, where we are seeing the market showing a series of lower lows, lower highs, lower lows, lower highs, lower low, lower highs, if this market wants to eventually push to the upside, the market is going to show us at least one of the bullish reversal patterns. So it could be a hammer, it could be a morning star, it could be a bullish engulfing, and so on and so forth. Once we begin to see this structure form, then we can anticipate that the market is eventually going to start a newfound uptrend, because it is a bullish reversal pattern which is found at the end of a downtrend. So to know the end of a downtrend is to know the bullish reversal pattern. I'm going to give you guys an assignment. I want you guys to research about 5 different bullish reversal patterns, and you can send them to my email or send me a message on Telegram at Delatrade, and let me mark you. Let's talk about bearish reversal patterns. Bearish reversal patterns may also form at the top of an uptrend, and it's also a signal or a reversal price movement. Or it's also a signal or a reversal signal to show that price is about to reverse all the way to the downside as well. Now, there are a couple of reversal patterns that are popular. We have the hanging man, the evening star, the bearish engulfing, and so on and so forth. Let's talk about trend lines. What are trend lines? I like to call trend lines the frameworks of a particular trend in the market. Trend lines are basically a graphical tool used to identify or confirm the direction of the price movement. So for example, we are looking at this market clearly. We can clearly see that this market is moving to the downside. So this trend line is also a confirmation that this market is moving to the downside. The most and efficient way to actually draw a trend line is to find 2 connecting dots that equally match. So for example, if I choose this particular first dot, which is this one, and this one, I have drawn my trend line perfectly. So anything that happens, price could possibly respect this particular trend line. Now this is a downtrend line. Now let's talk about an uptrend line. So for an uptrend line, I'm also going to be connecting 2 dots. So I have the first dot and then the second dot. So as you guys can see, this would be my first dot, this would be my second dot, and you can eventually see how price eventually broke. So with an uptrend line, it's also by drawing or connecting 2 or more dots, right? There are a few ways to be able to identify or how to draw your trend lines correctly. The very first point will be to identify the swing points in the market. You need to look for significant highs and lows on the chart. The second point is that you will need to connect the points. And the third point is that it will help you to be able to confirm the trend. Now, let's talk about Fibonacci. Fibonacci is a retracement or a technical analysis tool used by Forex traders to identify potential reversals, levels, or support and resistance areas in the price trend. It's based on the Fibonacci sequence where each number is the sum of the 2 preceding ones. So let's talk about the functions of a Fibonacci retracement. The very first is that it helps in identifying the support and resistance areas. Traders use Fibonacci retracement levels to identify potential support in an uptrend or resistance in a downtrend, or levels where prices might reverse. A second is also for price correction. It helps traders anticipate the extent of a potential price correction after a very strong uptrend. It also helps in entry and exit point, and it also helps with perfect risk management too. So now let's look at what the Fibonacci retracement looks like. So right over here, this is my Fibonacci retracement tool. To set up your Fibonacci retracement tools, all I'm going to help you do is I'm going to click this and I'm going to visibility or style. You need to pause this, take a screenshot, and apply these settings into your trading view. Now that you are done, let's proceed. So once that you're done, everything is going to look like this. How then do we plot our Fibonacci? So as I said earlier, Fibonacci is a retracement tool. So if we are basically trying to catch retracements in the market, it means that we want to know to which point the retracement ends. So if the market is in a downtrend, we want to know at what point this retracement is going to end for the continuation to continue. So Fibonacci allows us to be able to catch this particular market at this point and sell all the way down. So in this case, we'll be pulling our Fibonacci tool from this low all the way into this high, and then we are going to wait for the market between the 78.6 region to the 61.8 region, and we are going to sell all the way into these golden areas. Now let's head into the chart and look for some examples. So the very first way to actually catch retracement tool will be to look for a trend in the market. So first, let's look on the 1 hour time frame and see whether we can find a very clear trend. So over here, I'm going to be focusing on this particular uptrend and how we could have caught it. So you can see that this market is in an uptrend, showing a series of higher highs, higher lows, higher highs, higher lows, higher highs. Now let's say I wanted to get this particular move on the market. I wanted to find this particular move on the market. I'm going to be pulling my Fibonacci from this low point all the way into this particular high, which is this particular area. And you're going to see how price came to react in the 61.8 region. Maybe you're not seeing this clearly, so let me just have this over here. So right over here, you can clearly see how price has come to react on the 61.8 region, and then we're expecting price to buy all the way at least into this area. But we could have made enough profit on the market to be able to make some gains for ourselves. So you see that eventually, if we were taking this trade, we would have made enough money for ourselves because price pushed all the way from this area even into the golden zone, into our first take profits area. This gave us at least 50 pips in the market. So guys, I'm going to be showing you guys or giving you guys a bonus strategy on how to trade based on everything we've spoken about. So let's look at a very simple strategy that can help you in your journey. The very first thing would be that we need to learn how to identify the trends in the market. So in this case, I'm going to be opening a pair, say NZD/USD, and we are going to look at a very random situation. So if we want to identify the trend of this market, it's very clear. We look at this particular area and we can clearly tell that this market is in a downtrend. First, a trend line connecting 2 dots, and then we can clearly already see that this market is in a downtrend, showing a series of lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Now in this case, we can also use Fibonacci to catch the retracement points in the market. Therefore, we are going to be pulling our Fibonacci tool from the high all the way into the low, and we are going to be expecting the market to come into this zone, and then we are going to be selling all the way at least into the downside. So over here, you can decide to put in pending orders and set your targets all the way into this area and have your stop loss right over here. Now let's see how this market went. So just like that, we can clearly see how price literally almost to the T got into that particular zone for us. So right over here, you can clearly see that the market would have just come into our zone where the sniper entry tapped into our zone, or at least came close to our area point and then dropped all the way to the downside. This is one of the powerful tools of what Fibonacci can do for you. Now let's look at some of the strategies using candlestick confirmation. So also, I'm going to be looking for a clear trend in the market, and in this case, I'm going to be using this particular trend. So over here, this market is in a clear uptrend, and I'm going to be learning to draw my support and resistance areas. So right over here, I can clearly see that this is my support area, and I can clearly tell that this was my area of resistance which price finally broke. And what I'm expecting is that I'm expecting the market to come back into the area it broke and then reverse. However, what would I be looking out for? Yes, bullish reversal patterns. So right over here, I'll be patiently waiting for price to come into my zone. When price comes into my zone, what candlestick confirmation would I be looking out over here? I'll be looking out for what? Bullish candle confirmation. And right over here, what would I see over here? So this is a very strong bullish engulfing. This is a bullish engulfing candle. I'll have my entry over here, I'll have my stop loss over here, and I'll have my take profit at my first target. Or at least I'll decide to go for a risk to reward of 1:2. Now let's see how this played out. So just like that, we hit our target and we made good money for ourselves. This is a very simple strategy that you can use if you decide to follow this strategy very well. I have more things in the PDF, and so I'll be giving it to you guys for free. However, all you need to do is to check the link in my description and also join my Telegram community. Make sure to also sign up with XNest using the partner code ARAM, because that is what's going to guarantee you eligibility for the beginner's course. Thank you guys so much for watching this video. If you are interested in joining the mentorship, it's very simple. Head over to www.marketgodacademy.com and register for the lifetime course that is going to give you complete access from complete beginner all the way to professional trader. Thank you guys so much. I'll see you guys in the next one. Peace out.